Hello. Good afternoon. Can folks hear us?
All good.
All good. All right. All right, folks. We're just giving everyone a couple more minutes to join. I know we've got a few of the registered participants already here. You're waiting on a few more. We'll start in about 1:04, so we'll give people 3 more minutes. For folks who have joined, maybe just play around with the setup. There's a chat function on the right-hand side as well, which we'll be using during the session. So feel free to kind of send test chats, make sure they're working. All right, so I think we've got folks like 4 more minutes past the hour to join. So for folks who have joined, welcome to the Ask Me Anything hosted by CarbonBetter. We are, of course, extremely thankful for having you join us. I am Pankaj. I'm the Managing Director of the Climate Services team at CarbonBetter. I'll be moderating the discussion today. And then I'm joined by our head of the carbon business and the subject matter expert in this space, in my opinion, Dominic Sun.
Hi, everybody.
So today we'll start with the basics, right? We'll start with, hey, what are the voluntary carbon market? What's the purpose of it? Why should you participate in it? And what are the challenges associated with it? But most importantly, we'll get into some of the practicalities, right, on how you, as a potential carbon buyer, could really participate and effectively use it to achieve your sustainability goals. Before we begin, though, let me just quickly give a high-level overview of who we are as a company. I know some of you may know us, but for the others, CarbonBetter, we are a boutique sustainability and decarbonization-focused consulting firm, essentially helping companies across their sustainability journey, right? So from strategy to accounting, product LCAs, materiality assessments, climate scenario analysis, to effectively helping companies participate in the voluntary carbon market to achieve their sustainability goals. We have like our intro slides. Maybe, Dominic, I'll hand it over to you to quickly introduce yourself.
Yeah, sure. As Pankaj said, I'm Dominic Sun, Director of Business Development here at CarbonBetter. And I do lead our participation in the voluntary carbon market. And I think today, hopefully, we'll go through, we'll start with a lot of questions that I think we get asked all the time and very frequently in conversations we have. And then hopefully I don't do too good of a job of going through all the questions without leaving anything left for y'all to ask. But hopefully there's some additional questions we'll go through during the Q&A.
Perfect. Thank you. Thanks, Dominic. For me, like I said, Managing Director of the Climate Services team, got a ton of experience both in the industry as well as with consulting in energy and sustainability. Excited to be here and moderate this discussion for you. All right, so we all know the world of the voluntary carbon market is ever evolving, right? There's new structures coming in, new frameworks, new labels, constant change happening, all in the spirit of improving the robustness of the market, but at the same time creating a ton of confusion for potential market participants. Today, our goal is to really unpack this VCM for you and start with the basics, but then get into some of the nuances which you might have heard as you've read up or kind of heard about the voluntary carbon market. We do have a predefined set of questions for you, which we'll go through. But at the same time, as I mentioned at the beginning, right, there is a chat function, and we are hoping to utilize it throughout the discussion. So if you have any questions as we talk about certain topics, please do post them in the chat. And we have members of our team, Chris and Laura, who will be kind of regularly moderating and monitoring the chat and raising those questions as they come up. So with that, let us begin. So of course, starting from the beginning, what is the purpose of the voluntary carbon market?
Yeah, it's a great place to start, and I think on the surface it feels really simple, but I think it is important to set the table appropriately. And really, the way we would define the voluntary carbon market is that it's a decentralized marketplace where companies, individuals, and organizations can voluntarily buy and sell carbon credits to invest in the projects that reduce, avoid, or remove carbon dioxide from the atmosphere. And it's really our best shared economic system in order to support climate tech and projects that avoid or remove carbon emissions.
Thank you. Thanks, Dominic. Alex has mentioned there's a fair bit of echo. I am not receiving any echo at my end, but I don't know if that's a problem for others as well. All right. We'll keep going. If this is a general problem for everyone, please do let us know. Got it. Okay, maybe Dominic, yeah, we can mute each other when we are talking so that we can avoid the echo. Caroline, and Alex, is it better now? Oh, perfect. Okay, awesome. All right, so we briefly introduced the voluntary carbon market. Let's talk about the challenges, right? So what are some of the challenges in the current VCM environment?
Yeah, some of the main challenges, I think in a voluntary market it can be pretty tricky, but some of the main challenges I think we face are a lack of price transparency, an absence of a centralized marketplace to come to. If you can imagine, without regulation or without formally saying that anyone has to report anything or that there are any formal indices that need to be reported, it can be a bit difficult to coalesce some of these things. And you know, I think in the name of innovation, we've had a lot of people innovate different registries and alternative ways of doing things to try and do something different, but it's created a lack of consistency and a lack of centralization in some of that. And then there's the added difficulty in buyers diligencing project quality. I think in a place where I think we do observe quite a bit of attempts of flight to quality, as we would probably say. There's a lot of difficulty in how one does diligence whatever project quality is and what it means to them. And so all of this leads to a bit of a difficulty to scale the market in the largest sense, since every transaction and every evaluation is largely pretty bespoke.
All right. Thank you. Thanks, Dominic. And folks, as I mentioned, as we are discussing these topics, if there's certain specific questions which you have about these, please feel free to put them in the chat. Right. Moving on with our kind of predefined questions. Of course, naturally, we've talked about the challenge. We've talked about what voluntary carbon market, the challenges. Now let's talk about what are some of the role which intermediaries like us play in this space, and how does that help?
Yeah, that's sort of the next common question, right? Is, well, what does CarbonBetter do in the voluntary carbon market? Are you a broker? Are you a trader? And we said, no, we're an intermediary. And they kind of go, oh, what does that mean? Which really simply means we're a third-party company that facilitates the buying and selling of carbon credits between parties. That's maybe a little bit of an oversimplification of things, and I think we'll get into a lot more detail here in a little bit. But then the next common question after that is, and it's a really logical question, is, well, I don't understand. What value do you bring to the equation? Are you just stepping in between, and why are you in the middle of everything, just adding cost? It's a more complicated question than I think a lot of people would initially think in terms of what do we do? Why is that a role in the voluntary carbon market? Why is it an important role? And what value is brought to the equation? Because I think intermediaries often, maybe misused isn't the right word, but misunderstood. Intermediaries often take the blame for the lack of pricing data or for discrepancies in that pricing data and in the transparency of voluntary carbon market transactions. On the surface, it's really easy to think that intermediaries are just adding another layer to the process and adding cost to the market in a way that's not helpful. But really, I would say that CarbonBetter and most intermediaries exist to actually add transparency and provide liquidity for our clients where there really is very little. How do we do that? Obviously, is then the next question. And so how do we add liquidity? Well, via an intermediary like CarbonBetter, we are not beholden to showing projects to our clients and showing offers that are only limited to the projects we're developing or only limited to projects that we invest in. We can source our projects from anywhere. So as many developer partners as we have, or other brokers and intermediaries or wholesale traders or anywhere we can find them, we can source for our clients. And so we serve in a lot of ways to provide a much wider variety of projects in one spot. And then there's the simplicity of documentation and the liquidity that adds. The fragmented nature of the voluntary carbon market would mean for a lot of buyers that you need to balance the decision with either being okay with a limited number of project choices or to be contractually onboarded with dozens and dozens of counterparties in order to get at least a wide variety every time you're looking to purchase something, if it is something you do consistently. So what we strive to do is have a simplicity of documentation where if you can get onboarded and documented with somebody like CarbonBetter, or in this case with CarbonBetter, you get access to everyone that we have documentation with and all of our partners and all of the years of effort, candidly, that we have spent developing relationships, vetting things, onboarding, and all the documentation that comes with that, all in one place where you don't have to do that yourself individually. So with transparency and liquidity in one place that we attempt to provide, you also get that without having to figure out who holds what issuances. I think that's another piece of it that is often overlooked, is that it's difficult to know who to purchase project issuances from. There's no singular marketplace in which that activity takes place. There's no public ledger of who owns what issuances, and candidly, project developers often don't own the issuances themselves from their own projects in a lot of cases. So it's not just a matter of, oh, I want to participate, let me go and purchase these things. And then I think really quickly you end up in a place where like, wait, what registry? How do I find these? Who do I go to? So I think there's a lot that can be said for an intermediary that helps add both transparency and liquidity and clarity to a lot of things that happen in the voluntary carbon market.
Awesome. Thank you. Thanks, Dominic. And then we kind of briefly began touching upon some of the more nuanced challenges associated with the voluntary carbon market, right? As Dominic mentioned, transparency is a big challenge in this space. There is no central repository of things. And so as we get to our next set of questions, we dive deeper into the specifics associated with some of these challenges and how they can be overcome. So Dominic, you briefly began talking about it in the previous kind of response, but like, why is it difficult to know who can sell all of these project issuances?
It's a great question, and I think, trying to go in sequence here, right? Like there is no public ledger of who is holding what, and I think that maybe needs a minute to resonate with people, but there is a public ledger on all of the registries that are there for those that are quality, but that is there. It shows what is issued and what is retired, and not necessarily who holds the issuances. And so there's no public place to find out who holds those issuances. And many project, again, like I said, many project developers don't hold the issuances of credits themselves. So even if you know who the developer is that is listed for a project, you a lot of times don't know who to purchase that project from. It's not so simple. And so then I know probably what a lot of people are thinking is, well, I don't understand. Why wouldn't the developer of the project hold those issuances until they're sold to a buyer? Like, how does that happen? Or why wouldn't that be the case? And really the answer is, it has everything to do with the lack of traditional financing capability for a carbon project.
Perfect segue to our next question. It's like, what, I mean, again, naturally you would say, right, why can't project developers access traditional financing for these carbon projects? Like, what makes these projects different from some of the other capital projects?
Yeah, carbon projects are particularly unique, I think, in a lot of cases. In some ways similar to other capital projects, in other ways very, very unique. But the first and foremost reason why tapping into traditional financing can be difficult is a lot of them fall under project companies, right? You create a project company to operate this carbon project, and for all intents and purposes, there's no balance sheet, there's no credit history that exists for these companies, and so it becomes really difficult to go and to obtain traditional financing from traditional sources. Secondary to that is, if you can imagine, the lack of transparency and the lack of price reporting that happens, along with multiple different registries globally, creates an issue that there is no forward pricing curve. And there is no forward pricing curve that can be relied upon, even if there is confidence in the credit issuance that it will be issued for a project. So what that really means is, if there's no forward pricing curve, there's no ability to hedge, and there's no ability to preserve cash flows, and in so doing, preserve return for an investor or for a lender in that type of project. So if you can't ensure and preserve cash flows from a project, or have even a modeling capability of what that looks like, what those future cash flows may look like, it becomes really difficult to achieve traditional financing through traditional methods. Without traditional financing avenues, then projects are left with investors who often have rights to those project issuances, if you can imagine. And then it's also term off-takers, people who might commit to a long-term off-take from the project at a particular price. Those are the main vehicles by which final investment decision, or FID, can be achieved for those projects, which really means that project developers themselves don't frequently hold the majority of issuances from the projects, because they're committing them to either someone who is a long-term off-taker who's agreed to a long-term price, or committing them to an investor who's invested in the project and is taking them as either payment in kind, or has some rights to those issuances as they come up. So the lack of a single registry, continuously updated methodologies and protocols as well for credit issuance, third-party verification, uncertain issuance timing, all of these things that are products of the attempts in the marketplace to add rigor, to add reliability, to add assurances in the voluntary carbon market, really counterintuitively also have a side effect of creating an environment that's extremely difficult to model and doesn't fit in a traditional project financing framework for financial institutions or lenders or traditional financing methods. And so really, in order to get traditional financing, a project really has to try to make it easy for lenders to digest the risk in a way that they understand. And currently, it's just not very possible.
All right, we got a new question in the chat. Like, are there specific project types that you like to recommend versus others?
Yeah, I think we can probably hit some of these later on at the end as they come in, and we'll see if we can answer some of that stuff along the way as we go. But it's a great question.
Yeah, Alex, great question. We'll actually cover part of it in another section which is coming up, and then we can specifically answer your questions at the end as well. Thank you. Keep these questions coming. This is great. All right. So once again, like how do intermediaries like us help and support in creating that price transparency which is missing in this market?
Yeah, and I think again with a lot of this, really, like on the surface, it seems pretty straightforward, but the devil is really in the details. And so if we can conceptualize that, corporate buyers enter the marketplace once a year, maybe twice a year, at a high level quarterly, and so if it's not fully your job to be entrenched in the marketplace and to try and search for all these things on a regular basis that aren't really that transparent, and you're coming in maybe once a year and you're spending, a couple of months working on this, and then you leave, and then you come back 10 months later. If you can imagine, it's really hard to have a really strong idea of what the availability is for projects, what a fair market price is. I think a common question that I ask our corporate purchases all right, well, if you purchased before, like, how do you know you got a good deal on what you purchased? And it's hard to even assess where market value is for particular types of projects or particular regions or particular geographical preferences. So if you can imagine that you only come in every so often, an intermediary may be able to help that is entrenched in this day in and day out and have a really good finger on the pulse in a different way. There's a lot of help to be had there. Data services exist. There are any number of them, and they do a fantastic job in any number of ways of gathering what data there is out there. But for as much effort and rigor that's put into those data services, at the end of the day, they often rely upon bids and offers that are submitted to them as pricing data, as signals to be indicative of where pricing is, because most people don't see the end result of actual transactions. The actual transaction data isn't there, the closed price for them. Most people don't have that feedback. Most people aren't dealing with most of the suppliers of that data, at least, aren't dealing with the actual end corporate buyers, and so that data is really, really hard to come by. The issue with that is, I think, then you have the skew of a lot of that data coming from sellers, whether that's project developers or brokers or folks like that. So I think you have some skew in the way that data shows up in the data services. Whereas intermediaries, I think, I'll speak specifically about us as CarbonBetter, we see the actual transactions happening across our portfolio of sourcing, across our corporate clients, and we have good relationships with our supplier partners, and we have an idea of where a number of their previous transactions have happened. We get feedback even from transactions that we don't win of where they did transact, what types of projects did transact, and I think all of that helps give us a much clearer view of not just where someone is willing to sell something, or not just where someone is willing to say they're willing to buy something, but what actually has transpired, because I think there's a pretty wide gap there in a lot of cases. So working with a strong intermediary like a CarbonBetter, who has a pretty clear view and a pretty strong view of not just where somebody is saying they're willing to sell or buy something, but actual transactions that have happened, actual real data, not just bids and offers meant to suss out demand, I think can be a really big value add to folks who are trying to navigate that market, and a real help to pricing transparency in a market that is pretty fragmented.
Perfect. Yeah, no, thank you. Thanks, Dominic, for sharing. I not directly related, but kind of is one of the things is that a ton of carbon is not a ton of carbon, right? And even within the same project type, depending on where it is and what vintage and like how they're verifying that particular project, the price really varies. And so like all of this adds to the reason why pricing is different for these different projects, and the reason why it is not so easily available, right? Unless you're actually transacting in this market day to day. Perfect. So do intermediaries only add margins for information, or do they actually offer other essential services to justify the role?
Another great question, and I think, again, in the logical succession of going down this path, fair question to ask of intermediaries, right? Is it just for the data you have, or what else do you do? And the short answer is no. We don't just add margins for information, and here's why, right? I think for clarity's sake, right? Like we talked about long-term off-takers and investors as being essentially the methods of finance for projects to be developed. Maybe that long-term off-taker committed to a certain amount of credits over a certain amount of time, and they have had really effective emissions reductions, and they don't need all the credits they committed to for 10 years, 20 years, sometimes 40 years is the ask, right? And so, they've committed to a long-term offtake of credits from a project, and they maybe don't need them all by year 10 or year 15 as it may go. And so they've got excess credits that they need to then put back into the market. Or you have an investor that's taking credits in kind as their return on investment. When they come back to the market with what they have that is excess that they need to sell, they show up as, you guessed it, intermediaries into the market, right? An intermediary is anybody who is not the actual developer and the actual end buyer. So they show up in the market as intermediaries, and people look at them and they go, wait a minute, why does this bank, or wait a minute, why does this fund have all these credits to sell? And they're charging more than even if they have the data, right? They're charging more than what those credits sold for from the project. And people, quite frankly, a little bit out of context, get frustrated, right? Like, it looks like intermediaries are just, these were just issued, they're at an intermediary and they're selling it for a higher price. Like, why would they do that? They're just adding costs to the system. But out of context, you don't realize that, yes, upon issuance, it maybe did go to an investor, or it maybe did go to a long-term off-taker that does want to sell it for a higher price. But what you're missing out of the context is, if you really think about the risk built into that initial purchase from the developer, it often came with a prepayment in cash, right, for the term, with no guarantee of issuance. They're taking the risk that something goes sideways with the project and there's never even an issuance. It starts to make more sense when you think about the risk associated with that long-term off-taker initially, before there's any credits issued, that ex-ante, right, investor into that project, and the risk that they're taking by putting that capital in there. It makes logical sense then that somebody might want some return for that risk that they're taking, or that they got some discount to the market price for that risk and initial cash that they're taking.
Perfect. So this is, again, in the sequence of things going, Dominic, you briefly started talking about like why the difference in price between what someone might be selling it as a developer versus what you may be getting from an intermediary. Similar vein, like what causes the price difference between project developers and buyers?
Yeah, to go a little bit deeper, I mean, there is a lot of risk that gets taken by those that invest in an ex-ante way into these projects, and it's pretty logical that they're looking and taking multi-year risk with upfront payment. And often, if they have a portfolio of these investments, they're taking write-downs and write-offs in their portfolio consistently for ones that, have some timeline issues with issuance, or issue slightly less than initially was expected or what was modeled, or just don't come to fruition. There's a change, or there's an issuance issue, and rightfully so. I think for a lot of these folks that are making that investment, they're looking for some return to, one, cover the risk that they're taking, and then two, getting capital back so they can invest in more future projects. And so in cases like CarbonBetter, I would say another case is in cases like CarbonBetter, there's a lot of time spent guiding our clients, working with them to iterate on what it means to what does quality mean to them, prioritizing preferences, talking about value, leveraging our network of partners to provide liquidity, going back and forth on which ones they may or may not want, to diligence further. And then to reiterate everything that we've said so far, I mean, really on the surface, it may look like those intermediaries, not the developer, are merely buying credits at one price and selling them for higher. But I think as we're starting to unravel, right, if you start to pull on that thread a little bit, it's just a much more significantly complex situation than just, oh, they bought it at one price and they're selling it for a higher price and just trying to add margin into the system and take advantage of buyers who may be out there who can't see other things. But I think it's significantly more complex than that as we start to dig into it.
Awesome. Thank you. Thanks, Dominic. So far, I mean, we've talked about VCM at a high level, why it's needed, how it helps, what are some of the challenges. Now let's discuss some of the contradictory opinions which you might have heard or read about, which leads to an even more confusion, right? And the answers to which really depend on the details. And that is why I think Dominic has mentioned a couple of times as well that there's a lot of nuance and a lot of details associated with these projects. And it's important to consider them as you're thinking about these different kind of project types as well. And Alex, this starts to answer, it's not answering exactly the question which you asked, but it'll start informing some of the answer of your question on which project types to recommend versus not. Right.
Yeah, thanks, Pankaj. And I think there's a lot here, right? We'll start to talk about some of this conflicting advice or you know, things you might read in the news or statements you might see even from developers or other participants in the market where you know, someone might say, hey, ARR projects are high quality and offer strong additionality. And then the counterpoint to that, right, that people might say, well, but planting trees doesn't always mean growing a forest. And, you know, monoculture plantations aren't good and they're not the native species that are there, or poor management can lead to failure. And then on one hand, you know, oh, well, pay more and you'll get higher quality credit. So just pay more. And then on the other side, it's not necessarily true, right? Like, many top tier avoidance projects cost half as much as removals and deliver just as much impact. I think there's a study, there's some good numbers from Calyx Global that it's not a linear price to quality relationship, that you know, you can find them at numerous price points. Removals are better because they remove carbon from the atmosphere, I think is a pretty easy and on the surface, like, yeah, that's right. Right, like, but then the counter to that is, well, avoidance projects are often more cost effective and prevent emissions at the source. I think people talk about, you know, direct air capture and other technology-based removals and say that those are the future, right? Like, they offer permanent solutions that are, you know, there's no risk of reversal in some of these things, right? And so, but then the challenge to that is, well, why use really heavily energy intensive machines when there are nature-based solutions like planting trees that can achieve similar results? You know, someone might say, offset all of your residual emissions. And then the counterpoint to that is you don't need to offset 100%. And if you're over reliant on offsets, you can shift the focus away from direct emissions reduction. So all of these are actually true in all senses. There's just a lot of nuance in how you might dig into the subject or qualify those statements. And I think the trouble is, you know, people want to make declarative statements and very linear judgments on things, and people want clear guidance. But I think the trick is that this is a very complex market. I would almost liken it of you're talking, we want to be maybe sometimes over reductive to linear math when this is really like a multivariable calculus sort of situation. And I think the impact of over reductive statements like this sometimes oftentimes is to create confusion, like you said, Pankaj, right, on decision makers. And it's not surprising that potential market participants who are evaluating, oh, do I want to enter this market? And they look at this and they're like, wait, these are, highly qualified companies and individuals making all of these statements that are very conflicting, and they feel really indecisive and feel really confused when faced with that complexity. And so what do? Right? Potential buyers often, in a lot of cases, choose to wait rather than sort through all the details and the nuances of how to navigate what truth is there and why someone would make that statement, because that's not their full-time job, right? Like they're going to look at this couple of times a year at most, and if it's that complicated, they kind of go, look, if there's that high of a risk in me being that wrong, significantly wrong, I may just choose to sit on the sidelines, and it's it's understandable. What I would say is the need to somehow juxtaposition things as either or in this market and not yes and is an issue that creates a lot of confusion and hurts the market's ability to scale at a larger sense.
All right, so we've talked a bunch about challenges, about like these conflicting opinions, all sources which create additional confusion. Now let's talk about solutions. Right? Let's talk about like how can you ensure quality of credits when you're buying or when you go to market to buy these credits. So let's start with how can buyers ensure that whatever they are purchasing are actually high quality credits.
Yeah, I think this is a really important topic and a really important question. The first thing you have to do is to define what quality means to you as a buyer. And maybe that statement will make more sense as we start to walk through this. I think so. In this slide, right, like these are our CarbonBetter criteria for examining quality. And, there are objective measures at which you can observe quality. Ours largely line up with the ICVCM core carbon principles that the market has been working on for quite some time and are released around governance, transparency, traceability, third-party validation and verification, additionality, permanence, no double counting, and the like. But we also examine baseline measurement credibility, and we like to examine also the co-benefits as we diligence and work with our clients to diligence projects. And once you get a threshold of that objective quality, I think once you reach a certain threshold, the measures for quality become really subjective to your preferences. And it's usually some sliding scale for every entity as they make those decisions, and it's a trade-off between and personal preference of impact, risk, and cost. And so there's some sliding scale and preferential way in which you're going to look at and value those things at different places. So as long as you define what high quality means to you, yes, chin the bar on the objective measures of quality. But beyond that, as long as you define very clearly what high quality means to you, it's simply a matter of sourcing projects that meet your parameters of quality. And so just being really clear at the outset of what your definition of high quality is, and sourcing the appropriate credits that meet those parameters is really what I would say is the key to ensuring that you're purchasing high quality credits.
Awesome. Thank you. Thanks, Dominic. Yeah. And this is critical, right? Like, because integrity of carbon credits is a point which repeatedly has been brought up, and specifically over the last kind of year and a half, as it has been questioned. And so it is very important as you look to participate in this market to have a very clear understanding of what criteria to follow. And intermediaries can be helpful there because we routinely engage in this market and understand what these projects are and spend a lot of time actually going through the project kind of development documents to really ensure that all of these criteria are being met. Right, so Dominic, is purchasing from a recognized registry enough, or should buyers conduct their own due diligence?
I really think it's always important to do your own diligence and to go a little bit further. And I don't think it's ever prudent to just blanket trust things at face value. Do your own diligence. Being on a reputable registry is one major hurdle, and I think there is, again, that initial threshold of objective quality that does fulfill in a number of ways. But doing further diligence is always good to evaluate how a project fits with your specific quality criteria.
Perfect. All right. So we've talked about challenges. Hey, how should you think about evaluating these different carbon credits which are out there? Now let's talk about some of the practical ways in which you can actually make that decision to buy carbon credits, and you can decide which credits would make most sense for you. And I think, Alex, this is where the question which you had raised, we'll actually begin directly answering that question over the course of the next few responses as well. All right. So should companies prioritize removals over avoidance?
Great question. And a really important one, and I hate to say it, but really, as with most answers in the voluntary carbon market, the answer is it depends. And again, I think there's a lot of nuance in any answer you might give to this question. But really, if you submit to SBTI, that might be the one instance where it's a pretty clear answer. Then you don't really have a choice. The answer for you is yes. But generally speaking, I think this is all just a prioritization of preferences for you, and it goes to the variations of how you choose to define quality. Because I've yet to find an infallible argument that removals are objectively better in all aspects than avoidance credits and should be prioritized over avoidance credits. I think I would choose to answer this in probably the same way as I do a lot of the conflicting statements that we sort of talked about in the market, and that I really don't understand why there's a need to have this be an either or discussion. Both provide tremendous value, and it should be yes and for corporates looking to participate in the market, there are a litany of considerations into their definition of quality and their parameters on purchasing. But I think we would all say that with the urgency that we need to have in order to stay within 1.5C goals or even 2C goals, you need all of the above. In a market where removals credits are only 3% of the number of carbon credits that are out there, there's not enough even. So, further investment into all of the ways that we are impacting the carbon balance that's out there are all really important.
And maybe Dominic, building on this, could you also answer Alex's question here? Are there specific project types, irrespective of removals or avoidance, are there specific project types which you like to recommend versus others?
I think, again, it depends, right? I think it depends on what your corporate criteria are. It depends on what your corporate preferences are. There are people who would say, I want projects that I'm seeking to be geographically located and sited near where my emissions are taking place. And that is a major priority for me there. Or if I'm a beverage producer, I absolutely want these projects to have some water co-benefits because we produce beverages, right? And so what your particular preferences are going to often steer what types of projects I would recommend to you that fit your criteria, right? Your criteria of what quality means to you, it is probably going to narrow the field of what projects fit what your preferences are, and in turn, what you define as quality significantly more than maybe something that I might say, oh, this is a great project and here's why. I think in any category, in any technology type, in any geography, I think you can find a lot of high quality projects. But I think matching to what you as an individual are going to define as high quality is going to be more important. For us, it's about finding the right solution for you, and not me telling you what the right solution for you is, because you know best what matters the most to your constituents, to your stakeholders, and to your emissions profile.
And one thing I'd add to that, Dominic, is we always recommend a portfolio approach as well. So it's never like, hey, just buy one project or one type of project. We always recommend a portfolio approach where you have a basket of different types of projects. And as Dominic mentioned, they absolutely have to align with your overall corporate strategy and sustainability strategy, and how you envision carbon credits fitting into that strategy, and how you want to tell that story, right? Which we'll get into in the next couple of questions as well, because there's almost always, whenever someone is purchasing credits, there has to be and should be a story around it, and it should naturally complement what your overall sustainability strategy is as well. Right. So next question: what's the best way to talk about carbon credits once purchased?
Yeah, I think the best way to talk about the best way to talk about carbon credits once you purchase them is really what I would say is the best way to talk about anything in sustainability. You should be transparent and traceable as to why you are making the voluntary choices that you are, why you've chosen these projects, and why they're impactful to you. Again, a lot of these are going to be relatively bespoke choices that fit your company, and if you're explaining why this is the most important, why these are the most important factors to you for quality, and this is why this project fits in there, I think that is a very clear and decisive way to be open and transparent and traceable with what choices you're making and why, and this was the information that you made that decision based on, and why that's impactful for you and your stakeholders.
Right. Are there any particular trends which companies should be aware of as they navigate the voluntary carbon market? I feel there's always something which is happening or in the news, which sometimes overly influences how people are thinking about the VCM.
Yeah, I think the market is always developing. The market is always progressing, and I think we in the industry talk about it as kind of progressing from the VCM 1.0, and now we're at the 2.0 version of where we are in some respects. But I think as we continue to go from here, we're at a bit of an inflection point in the voluntary carbon market. A lot of capital has been spent, a lot of innovation has happened, and a lot of attempts at differentiation have taken place. The proverbial spaghetti has been thrown at the wall, so to speak, and we're seeing what sticks. There's a lot of capital that's been thrown out there, and I think a lot of larger corporations at hyperscale they want to see what the return is on the millions and tens of millions and sometimes hundreds of millions of dollars that have been put out there into projects that have a long lead time. Investment in technology that is developing, and I think we're getting to the inflection point where a lot of checks have been written by a lot of big companies and a lot of big investors, and they want to see how does that start to come back before I deploy even more capital. So you're starting to see maybe a little bit of slowdown in that capital, and I think that's probably why you start to see, if you look at the data, a slowdown in the number of issuances that are coming out right now. You can attribute that to any number of factors, but that's probably a little piece of it too. But you're starting to also see, those hyperscale organizations, the Microsofts, the Googles, the other folks, start to be more honest and talk about the investments, the ex-ante investments that they've made in early stage carbon projects or really, really early pre even stage carbon projects, that they're starting to talk about them as grants. And if you think about that, what that really means is there is zero expectation that money or return ever comes back. For them to change the nomenclature that you're talking about, that is, it tells you the risk that I think a lot of companies are associating with investing in a lot of these projects that way. Really nascent technology that I think any of them would say is vitally important, right? If you look at the time series of what people talk about in terms of their decarbonization, there's always that bucket at the end that says technology change. And I think if we ever want to achieve that bucket, this is the way we do it, right? And that's their view as well. This is why we're investing in that technology. There's no other way we get to a place where that technology advances and we have something different that doesn't exist today without investment in those projects. But we're in a tighter capital market. We're in a tighter capital environment, and financial rigor and returns matter for a lot of those investors. And so we're at a little bit of an inflection point where I think there's some realization in a lot of folks that the evaluation of deployment of capital, whether it is into a carbon project or into any other capital expenditure, is largely going to face competition as money and cash is competed for in corporations. So at the end of the day, this is a voluntary market, and they're choosing to spend money on these things voluntarily. So it becomes tricky when okay, well, what is the other alternative use for this capital? Those challenges are starting to enter. The flight to quality continues, and again, like, I think there's plenty of news articles that have come out along the way, and people are, it's not just a giant rush to just, as Pankaj, you said, right? Like a ton is not necessarily a ton is not necessarily a ton. There is a flight to quality, and what does quality mean to you is really, really important to define. And then shared objectives and transparency, I think, are becoming more and more vital. Credit insurance continues to develop to address protection of people's investments and protecting against, shortfalls in issuances or a failure to issue. So you're seeing this market develop from tons of angles. The market is realizing that in order to really scale, and I think that's the objective for everyone, right? It's not to have this be such a fragmented market, and to not have it only be for certain types of buyers and not others. In order for this market to really scale, there has to be consistency, there has to be rigor, there has to be efficiency, and there have to be low barriers of entry for participants to want to get in there. Whether that's legal to pricing and transparency and liquidity, like, we have to make the barrier to entry low for participants in order for this to scale. So I think we're getting to a bit of an inflection point, to circle all the way back to what the main point is. Of there are a lot of things that have started to happen, and things that we're starting to see the effects of, that are going to be really hardly evaluated and taking a closer look at. Okay, now what do we do next? And so I think it's an exciting time to look at the voluntary carbon market. It's an exciting time to evaluate projects, an exciting time to really invest in these things that are making a difference, tangible differences, and hopefully, see where this goes next, and be on the forefront of having this scale even more. I think it's an exciting time for CarbonBetter to be an intermediary in it, to help our corporate clients as they seek to source credits and to be a key player in this market.
Yep. Awesome. Thank you. Thanks, Dominic. I think with that, we come to the end of our kind of predefined questions. I know we've got a few minutes left. I'll open it up for the participants for any questions which you may have. You can put them in the chat.
Feel free to type them into the question section, or we'll see them in the chat if you type them there as well. But.
Mm-hmm. Right. I'll assume that we're doing a really good job answering any and all of your questions on this space.
It's possible that I may have shot myself in the foot by going there, but hopefully informative. That I think I was trying to put, and we were trying to put out there, all the questions that I think we commonly get, and the dialogues that we commonly have with our clients and with potential clients as we have the conversations out there of trying to dig deep, and I think dig to that second level of, sometimes as I mentioned, the over-reductive statements that are made, or the headline snippets, right, in our society that we have out there of, oh yeah, that sounds like a great thing. I think, well, you probably need to go a little bit level deeper to understand what's actually happening. Hopefully, this is helpful for everyone to dig in a little bit further.
All right, if there's no more questions, once again, thank you. Thanks a lot for joining us today. We really appreciate your participation. You will be getting a replay of this entire video in your emails, as well as links to some of the information which we had shared during our chat. all through email. We will also be creating like a summary post in case you don't want to kind of go through this entire video again, and we'll post that summary in a few days. Okay, right. With that, once again, thank you. Thanks for joining. Have a great day.
Thanks, everyone.